3, 2, 1. What's up?
All
man?
right. We're back.
Physically and mentally.
Oh, yeah. Every ways, all the way around. This is good. It's good to be back.
I know. I like it better when we're in the studio.
Yeah.
We can bounce back and forth.
Yep.
You don't
Definitely
have to sit there and talk the whole time.
Right. No, yeah. And as it turns out, this is going to be the September 11th edition. Comes out on September 11th.
Yeah, we're doing it a little bit early because my crazy butt is going to be walking across the Grand Canyon on September 11th. And I'll report back to you next week on that one.
Hopefully.
See how it felt.
Hopefully you'll make it back.
If I'm not on next week's show, you'll know why. Got lost in the Grand Canyon. We're walking rim to rim on September 11th.
That's awesome.
Horrible idea.
Yeah, well, somebody's got to do it.
I know I talk enough people into crazy stuff. I had to do it. So,
yeah.
What we got this week, man?
All right. So we've had some people asking for this, but it's something I've been wanting to do for a while, and we've talked about it in the past. But risk management, right? It's been a crazy year on the market. You know, we did this bear market rally webinar a couple days ago.
Yeah, on Facebook, in the Facebook group.
Yep.
If you guys missed that, sign up for it. You get all the old ones too.
Yeah,
so.
yeah. It was a good one. There's a lot of good information in there. You know, there's been a lot of talk about how every time we've had a rally that's gone above a 50% retracement from the low in a bear market, it always has been the end of the bear market. And it seems like that concept got picked up by a whole bunch of different people on YouTube, and they all try to explain why that is. So why the June low is in place, and we're not going to go to new lows. And we may not. The June low may be in place, but just because we get a 50% retracement from the low does not mean that the bear market's over. It will mean the bear market's over if we get back above the August highs, right? But if we get below the June low again, no, the next leg is down. Things
Sure, we're going to talk about it.
Yeah, we're going to take a look at it. Things aren't looking great right now, but who knows? We haven't hit either one of those lines yet. So, right now we're in no man's land. But in the meantime, let's take a look at risk, right? Because it's a huge topic, and people don't. It varies if you're talking about TSP, if you're talking about a brokerage account, it can mean a whole bunch of different things. So for our purposes, and what most people think about is downside risk, right? How much am I losing? And that's obviously a big topic of conversation this year, right? How much am I losing? So it's my risk of loss. And you want to protect against that, right? In an environment where the market's going down, you want to protect against that downside risk. The second big one is the upside risk, right? Which is opportunity cost. We have the two rules basically that we kind of live by, right? Don't lose money, and you have to be in the market when the market's going up to make any money.
Right.
So and those are two almost 180-degree rules, right? So you have to be able to balance them. And how do you do it? We do it by technical analysis. People use other methodologies or whatever. But if you're not in the market when the market's going up, your account's not growing.
Right.
If you leave your money in the market when the market's going down, your account is shrinking.
Right.
So those are the two major risks from my perspective, right? A lot of people look at age as a risk, right? If you're in retirement, do you trade differently? Do you come to how you manage your TSP differently? I don't.
Right. We don't.
Right?
Our methodology is the market doesn't care how old I am.
Market doesn't care anything about me whatsoever.
Right.
Doesn't care. I mean, the only thing that matters in terms of age is that if you're retired, you don't continue to contribute to TSP, which means managing downside risk is even more important because you can't, you're not adding contributions. So the whole argument about, buying shares cheaper doesn't exist when you're a retiree.
The only thing that has changed for me as I've gotten older, and it really has more to do with where I'm at in my life more than the age itself, right? And I was talking about this with another recent retiree buddy of ours, and it's not so much do I invest differently. I don't. In the market, I don't. What I do differently is my entire portfolio might be different, right? Whereas I'm younger, my portfolio probably is just my TSP.
Right.
My personal overall portfolio.
Yep.
And I think that's sometimes where we kind of get lost too. And it's putting this stuff in context. So if as I approach risk management in my larger portfolio,
yep.
maybe I have a brokerage account, maybe I've got some real estate, whatever.
Yep.
How much of my entire portfolio am I dedicating to any given thing?
Yep.
That can change.
Sure.
And that is what you get from a good financial advisor.
Yep.
Is the shifting of that larger portfolio. Not so much am I going to be in G versus C versus S, right?
Right.
But that's where we come in. Our
little
kind of
piece.
our little piece is, but if I'm in the market when it's trending down, I'm losing money. If I'm out when it's trending up, I'm not getting money, right? So we're talking about this one piece of what I would say in my personal circumstances is my larger portfolio, right?
Right.
And so we don't want you to take this methodology and think it applies to everything, but it definitely applies to retirement accounts, whether it's a 401k IRA, it's or TSP. This methodology is built for that, right?
Yeah.
If you want to grow money over time for retirement, this is what we think is the methodology that works for that.
For this
right?
piece of it, yeah.
Yeah, for this piece.
Right. But exactly like what you said, like if you own your home versus renting, or if you own some real estate property.
Totally different.
Some rental property.
Impacts.
Yeah. All those things is actually diversification, which we're going to talk about, and position sizing, which you kind of referred to a little bit. And so we're going to take a look at that. But yeah, so age and whether or not you're in retirement, how much are you spending and what are your investing goals? And then, of course, inflation, right, and the degradation of the value of the dollar. So all these things are risks, and that that's certainly not an inclusive list. There's all kinds of risks that we're trying to mitigate, and we are just looking at our one little piece here in TSP. So what we're going to kind of look at is risk management from two perspectives, right? Basically passive or active. In TSP, what they push everybody to is the L funds, right? The L funds are passive, and we're going to get to a slide on that comes from the TSP. It's a passive investment, and it's age-based, but their definition of risk is that it's not market risk, right? It's based on as you age, you should have less exposure to stocks and more exposure to bonds because bonds are less risky than stocks. Ordinarily, in most markets, that does work. It makes sense that it hasn't happened this year, right? The F fund is down as much as the C fund is, but the concept of it has worked over time. But it's passive. You're not trading. You're not managing your account when you do that.
You would leave it in there for the entirety. What's really strange is when people bounce between L funds. You're missing the point.
There's the bouncing between L funds, but then there's, I'm putting 30% in L fund this and some in C and some in S. That is completely missing the point of L funds. I mean, if you ascribe to that risk methodology, you should go 100% into whatever L fund you want and leave it there and never look at it again.
Right. If you believe in that methodology. Otherwise, you're missing the point. And it's too much to go through into this show. Yeah. But you can go back and we actually have a video we did early on about the L funds that kind of walks you through this. It's on our YouTube page. Look for it. It's good stuff.
Yeah. Diversification is another big one, right? If you're evenly distributed between the stock funds, you're diversifying to the extent that you can in TSP because you only have three stock funds, one bond fund, and a money market. Like that's it. So if you do go to all three of the stock funds, you're hitting A, every option that we have, but B, the biggest companies in the U.S. for the S&P 500, the other 4,500, mostly small to mid cap companies in the U.S., and then a pretty good chunk of the world, which isn't doing very well right now, but that's that. That would be diversification. Position sizing, right? You don't have to reallocate either 100% stocks or 100% G fund. You don't have to do that. It seems like everybody kind of does that or does some kind of, 25% across the board or whatever. You don't have to do that. You can look at the market and say, all right, I'm not so sure about this. I'm going to put in my portfolio size, my position 50%, 25%. You know, I'm going to do 25% today. If the market keeps going up, it confirms my thesis for where the market is. I'm going to add another 50% or whatever. Now you have to deal with the 2 moves a month rule, but you don't have to go all or nothing. I mean, position sizing can be pretty important. And then rebalancing. Rebalancing is also a passive thing. They sort of do it in the L funds, but it's more of outside accounts. It's usually either annual or quarterly, and they'll rebalance. So the idea is that if you want to be 50% in stocks and 50% in bonds, right? And you look at your portfolio every quarter. If stocks have been doing well, and now your percentage, because stocks have been doing well, if your percentage becomes 75% stocks and 25% bonds, you rebalance that so that you're back to your original requirement of 50-50.
Right.
But what that actually is doing is, well, let me just say both sides of the argument. From the way I look at it is, you are selling the things that are going up in value, okay?
Right.
So that you can buy things that are going down in value.
Mm-hmm.
That doesn't make sense to me. The other side of that argument is, you're locking in your gains from this side, and you're buying shares cheaper on the other side. Okay, so those are the 2 kinds of ways you look at it.
Which may work in a brokerage account, but doesn't generally. That's not how it plays out in the TSP.
No, you can't really.
We've gone into that.
Yep.
You guys can go back and look at it. But if you think that you're buying shares cheaper, you're missing the point.
Yeah, and it only applies if you're an employee. It doesn't apply if you're a retiree anyway. So, but those are basically passive ways to manage risk. And the 2 active ways we're going to look at is trend trading and technical analysis as a whole. All right. So passive risk management. Okay, Lifecycle Funds. This is it's taken from the TSP site. This is what they're pushing us towards. The 10 funds, the diversified mix of the 5 core funds, right? G, F, C, S, and I. They're designed to let you invest your entire portfolio in a single L fund, okay, which is what we're talking about, and get the best expected rate of return for the amount of expected risk that is appropriate for you. That sentence drives me absolutely up a wall. It implies a whole bunch of things. Get the best expected return, right? I don't really understand how they can expect a return, because the market gives you a return, not the system that you apply to it. So best expected return, I have no idea, for the amount of expected risk that is appropriate for you. So I don't know how they determine. They determine that the risk that's appropriate for you is based on your age, and as you age, you should be less exposed to stocks and more exposed to bonds. But that's how they make the determination that that's the risk level you should be at. I haven't the slightest idea.
Yeah, I've never been a fan of the actual term L fund, because they make it seem like that's an actual fund. No, it's a portfolio of the TSP funds.
Right.
It's a combination of all the funds in a certain, and it rebalances as you get older. Yep. And it's definitely based on age. So if you buy into the concept of that risk is lower because you're moving into the bond funds as you get older and less in the stock funds, just think about what you would be doing right now in any given point in your life. And look at this year where both are going down. Right. Would you still buy into that? Would you still believe in the kind of L fund methodology? I don't think you would. And I like years like this for learning impact, right? Yeah. Because if they don't happen, then you're just kind of, it's theory. It's, that never happens. Right. Happened in 2022, and we talk about it was 2008, or am I getting the year wrong? 2018. Yeah. Yeah. When you're as old as we are, we missed decades. 2018, we did well in the F fund. And most people thought we were like crazy. Why are you in the F fund? Because it's making money.
Yeah, honestly, the F fund has been in a bull run for 40 years. The bond funds have been in a bull market for like 40 years. Ever since the 70s and the Fed started lowering rates, prices of bonds have gone up, and the price of the F fund has steadily gone up. And it's much lower risk than the stock funds. It hasn't gone as as high at the highs as the stock fund
Just
has.
the returns aren't as high because they don't.
Yeah, the returns aren't as high, but they're way safer until 2022.
Right.
This is, I mean, the bond funds are down double digits for the first time. I mean, I've seen some articles like this is the worst period for bonds since the 1700s.
Yeah.
It's, maybe
So
it's
imagine if you are in an L fund and you've been in that L fund for all these years in your career, and that's where you're sitting and you're watching that balance drop.
yeah. And if you're in the L, late, 2030, let's say, or 2025, so they're like close to the L income funds.
Mm-hmm.
Yeah, you're not doing yourself any favors in there. And this is when it's supposed to be protecting you the most.
Right.
Yeah.
That's why we don't think that methodology works well.
So every quarter, target allocation of the L fund, except the L income fund, are automatically adjusted, and they shift toward or from what they say is higher risk to a lower risk as you get closer to your target date. When it reaches the target date, that fund goes out of existence and you become part of the L income fund. One important thing about the L funds is they stick to their target allocations for a full quarter, regardless of what the markets do. Every trading day, some of the individual funds in the L fund will do better than others. At the end of the day, the individual funds that did better will make up a higher percentage of the L fund than the ones that did less. To maintain each L fund's allocation, we rebalance it at the end of every trading day. We do this by buying and selling the individual funds that make up the L fund so that the percentages go back to what they were at the beginning of the day. In effect, we're buying low and selling high at the end of every trading day. I was laughing out loud as I'm putting that slide together.
I know. And we talked about it when we did the L fund video. I mean, it just doesn't compute.
No.
It's not what's really happening. They're rebalancing.
Yep.
They are doing that. But to tell you they're buying low and selling high.
Yeah, as a fact.
Like that's happening. No, it might not be, especially right now.
I mean, are you selling high? Yes, that fund went up.
Yeah.
Why do I want to sell that fund when it goes up that day? Only to buy the one that went down.
Well, actually,
that day.
they don't even care whether it is up or down. They're just rebalancing it regardless. That's my problem with it. If they actually cared whether it was up or down, that's different. They're rebalancing regardless of what the market is doing.
That's right. And they tell you that.
Yeah.
Doesn't matter what the market does. Yeah, it's crazy. Anyway, so the diversification, right? Most of the rest of this comes from Investopedia. Diversification is a risk management strategy that maximizes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt to limit exposure to any single asset or risk. The rationale is a technique that a portfolio constructed of different kinds of assets will on average yield higher long-term returns and lower risk than any individual holding or security. So in terms of TSP, I mean, how do you diversify? You do a 70-30 stock to bond split. If you're 100% CNS, 50-50 CNS, you're diversifying across the United States, but you're not taking into account anything outside the U.S., and you're not taking any bonds into account. So if you really wanted to diversify in TSP, you'd basically do 25% CSI and F, and that would be your maximum diversification.
Which is what we've done at times, depending on what the market's doing.
Sure. Yeah. Okay, and then position sizing refers to the number of units invested in a particular security by an investor. An investor's account size and risk tolerance should be taken into account when determining appropriate position size. Position sizing refers to the size of a position within a particular portfolio. I don't need to go through all this. So the idea is that you don't have to be 100% in the stock funds or 100% in the G fund. You can use portfolio sizing to kind of manage your risk as you try to be on the right side of the market. And then rebalancing, okay, portfolio rebalancing it safeguards the investor from being overly exposed to undesirable risk. It goes along with the L funds, but it also ensures that the portfolio portfolio exposures remain within the manager's area of expertise. So, assume that a retiree has 75% of their portfolio invested in risk-free assets. So for us, that would be the F and G funds, with the remainder of it in equities, which would be the CS and I funds. If the equity investments triple in value, then 50% of the portfolio is now allocated to risky stocks. An individual portfolio manager who specializes in fixed income investments would no longer be qualified to manage the portfolio, as the allocation has shifted outside their area of expertise. To avoid these unwanted shifts, the portfolio must be regularly rebalanced. I mean, you can't make this stuff up. This is how these guys make money.
I just have myself on mute. What I feel bad about is, we're sitting here giggling like when we read it, and what is the sad part is that we're in the business of education, so we're trying to explain to you guys why this is kind of silly. But when you read that and you don't know any better, you just kind of take it as fact. You just think of, well, that's the way it should be. Yep. And it's the nuances. The devil's in the details. Yep. The fact that they're saying like, well, because this portfolio did well and outgrew its balance of the way then we should rebalance it. Right. Regardless of what the market's doing, regardless of how well the portfolio is performing, we're going to rebalance that because I'm a fixed income advisor, and that's the only way I can advise you.
That's right.
Is because we have to make sure it's balanced in that favor of that. That doesn't make any sense.
No.
But they will convince you that makes sense.
If they convince you that over time a 50-50 portfolio or some other percentage is the best way to go, and you buy into that idea, then everything they say makes sense. And you want to lock in those gains when you get them, and you want to rebalance your portfolio. And and
again, I try to always point this out, right? That some of this stuff we're talking about goes a little bit outside of the context of the TSP.
It does.
Generally speaking,
the concepts apply, but
the concepts definitely apply. So don't think that they don't apply. But when we really start digging, and we start peeling the layers away, what we're really talking about are tax implications, right? How that overall that part of your portfolio impacts your taxes. And if we're talking about in a brokerage account, we're not really concerned about things like how many moves per month and if it's commission-free trading, all that, right? That's different.
Yeah,
right?
No, any of the stuff that you're talking about in a retirement account, a qualified retirement account, doesn't have any of those tax implications. But once you get outside of that, all that stuff applies. Rebalancing costs you every time you do it.
Yeah. Now, so that's a good example. So why would I want to do that? What you just explained here, rebalancing, right? Why would I want to do that? If my financial advisor was telling me to do that in my IRA or my 401k, because I can move as many times as I want a month.
Your brokerage account. Outside of a retirement account, right?
No, I'm saying in my IRA, I'm saying let's go into a retirement account. Okay. If my advisor is telling me this is a good idea, I hope you guys that are listening go, whoop, 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 flag.
Yeah.
Right? Because because that's what they would be advising you on. They wouldn't be just advising you on your brokerage account. Right. They'd be telling you, oh, this is what you got to do in your IRA and your 401k and your brokerage account. No bueno. So just, folks, take time to read through this stuff and think about it and actually think about what it's saying. And when people tell you that a methodology like this works, think about it yourself. Put it in realistic terms. If I did this in my account, what would be the impact? And of course, what we always argue is the market doesn't care about any of the stuff we're talking about. It's going to do what it's going to do. How am I going to respond to what the market does?
Yeah, and if you're responding to the market, you're not doing any of this.
Exactly.
Yeah.
But we're biased.
Yeah, quite a bit. So calendar rebalancing is the most rudimentary. It's the simplest and what most people do. Strategy simply involves analyzing the investment holdings within a portfolio at a predetermined time interval and adjusting the original allocation at a desired frequency. That's all. It's just monthly and quarterly. Weekly doesn't work because it gets overly expensive, and a yearly approach would allow for too much
portfolio drift.
I don't know where they get this stuff from.
They make it up.
All right. So those are all basically passive ways of managing risk. And I'm only going to go look at two active management ways. Okay. So again, all this stuff is from Investopedia. You can just go to Investopedia and look at it and read through all the articles because I only pulled out the parts that I wanted to talk about. Trend trading. Okay. We talk about that essentially all the time on the show. So trend trading is a trading style that attempts to capture gains through the analysis of an asset's momentum in a particular direction, right? We want to be on the right side of the market. When price is moving in one overall direction, either up or down, it's a trend. Trend traders enter it into a long position, meaning you're buying stocks, when the security is trending up. An uptrend is characterized by higher highs and higher lows. Likewise, trend traders may opt to enter a short position, right? We can't do that in TSP, but it's the exact same thing. When an asset is trending lower, it's characterized by lower highs and lower lows. Traders use both price action and other technical tools to determine the trend direction and when it may be shifting. Okay, so you get the idea. It's the same concept as applied to downtrends. Yeah, you get the idea about that. So here's what it kind of looks like. We do charts similar to this every show, and we're going to do it at the end of this one. This is a 5-year chart of the C fund. You could a very simple way to do it is to just follow the trend of the 20-week moving average line, right? You can see that if you followed that trend and you are in the stock funds when you are above that line, and you get out of the stock funds when you're below that line, there are some in and out periods in there, right? It doesn't work 100% of the time, but you're going to get the majority of the runs up, and you're going to avoid the majority of the big losses, right? These are the things that we're trying to avoid, and you're going to be in the majority of the time, okay? And that's just using one simple trend line on a weekly basis.
And it's important to note that we specifically, as we look back at that chart, we are not trying to time it and get out before it happens.
Nope.
The trend changed, we're out. We didn't try to anticipate. Right? We may have lots of thoughts on what may happen, but at the end of the day, we're not going to make a move until the trend has actually changed. So by design, we're going to have a little loss.
Yes, definitely.
Right? Because we have to see the
loss
trend
relative to the all-time high.
Exactly, but what we're wanting to miss is those large losses, right? And so that's where people kind of get lost in our methodology, where they think we're trying to do market timing, and that's not the same thing. Market timing would be trying to anticipate that before it happened both ways. And what we want to do is just miss those large downside, right? And what that really does is protect your balance. So your balance doesn't go down. It just kind of stays there until we decide to get back in it. We get back in it and it starts to climb again. Oh, the trend changed. I'm going to go back over here to G and just kind of wait it out. And the worst thing that happens is you might miss a little upside, right? But the bigger jumps that Jerry just circled, we're not in the market. We're not going to be in the market.
Nope.
We're not going to do it. Why would you?
2018. I mean, we were positive for 2018. I don't know too many people that were actually up in 2018.
Yeah, all we're doing is following the trends. And if that line is all you used, anybody listening to this, if that's all you used, you would be far better off than any L fund or any other methodology. Just that alone.
Yep, that's just one tool. And so that's trend trading, and it's pretty simple. The last one is full-on technical analysis, right, which is what we do. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends, blah, blah, blah. If you guys have watched the show, you get an idea of what we do. I'm going to show a chart on it in a minute. But again, this is from Investopedia. These are what they say in Investopedia is the general technical analysis indicators that people use. The asterisks here are mine because I also added Fibonacci retracements and Elliott wave count. And so this is an example of the S&P 500 RC fund. It's a 10-month daily chart, okay? This is the first chart I look at every day. It's there's a lot going on in here, and I'll just point out a couple of things. Where we are right now, right? Here was the top in January 2022. We came down in a 1, 2, 3, 4, 5, which gives us a 1, right? ABC correction for a 2. 1, 2, 3, 4, 5 for a 3, a 4, and a 5, which gives us a bigger 1, right? So now we have a 1 leg. We had an ABC, gives us a 2. Now we have a 2 leg. And now we're going into the 3 leg. Okay? That's the Elliott wave way of looking at it. We put in a high here. We came down, we came up. We came down. Now if we just connect this high and extrapolate it out, we get that dotted trend line, right? When we had this recovery, it hit that trend line exactly and rolled over, okay? They're all different technical analysis things, right? We did the Fibonacci retracement from the top to the low in June. Price recovered a little bit. This was the 50% line, a little bit higher than 50%, right? And then rolled over. So all these tools, and then you got, of course, relative strength and CCI and MACD. So all these tools you put together to help you manage risk, which is the point of this whole thing.
Right. And
it's
the
not to
difference
pick the tops
between
and bottoms,
those
it's to
two
manage risk.
charts, kind of flip back and forth between that chart and that one, okay? Now that one is obviously simpler, right? Now go to the next one, and that one is busier. The only difference between those two charts, and I think this is really important for people to grasp, the only difference is the level of confidence you're going to have on the trend changes. You only have one indicator on the one we showed, which is larger trends, which again, I would say if 99% of the people in the federal government and in the military just manage their TSP off that alone, you're going to do really well over a career.
You look at it once a week, that's it.
Bam. That is where we start. Now, we go farther because we have the ability to, and those other indicators give us more confidence in these trend changes, right? So they allow us to be able to have a higher level of confidence that truly is a trend change, right? Now, many people can use technical analysis, and Jerry included, to give them a stronger confidence of anticipation of where the trend is going to go, right? And so people that are really good at technical analysis, they're able to use all these tools to give them a higher probability, right? This is just analysis. If you talk to an intelligence analyst or a financial analyst, it's all analysis, right? And so what you're looking for is a higher probability that X is going to happen. And if I feel good about that 80%, so this is where it gets a little gray, right? So if the analyst is confident in their tools and they say, I feel like there's an 80% probability that this is going to happen, they may feel comfortable doing that.
Right. And the other half of that is, I will know if I'm wrong when this happens. Right. Which is what we call the line in the sand. Yeah,
exactly. So we dig deeper. And so we do that because we want to be able to have more confidence in our trading abilities. But again, going back to that original slide, the first slide, if that's where you live your career, you're going to be okay because you're going to miss those large drops. Now, when we add all these other tools, we might miss some of the smaller ones too. Right. And that's, we're trying to maximize our ability on upside and downside. Right. And so anyway, back to you, Jerry.
All right. So the bonus chart is gold. Okay. We did gold last week, and I wanted to do it again for a couple of reasons, but this is the chart we put up last week. Okay. It goes back to 2005, and it's a monthly chart. Okay. So this is a 20-week moving average line, 20-month moving average line.
And this is gold, GLD.
GLD is the ticker symbol for it's the SPDR S&P gold ETF. So what we talked about last week is that, we hit this high here, we hit a high here, we hit a high here. There's a lot of support at that moving average line there, and then it failed, right? We got 2 weeks of failure to get it back above that moving average line. So I wouldn't go anywhere near it based on this chart, okay? So that's what we talked about last week. Now, nothing substantially has changed this week, but I went back and looked at gold on a different chart, okay? So, and this kind of illustrates risk management. And for the sake of full disclosure, I actually bought this morning, okay? So now we're looking at a 3-year daily chart of gold, okay? So we put in a low here, came down, put in a low here at the same level, came down, put in a low here at a little bit higher, and then a few days ago we put in a low right at that same level, okay? So in terms of risk management, and why would I buy it here? The first thing is we are at a support level that has been tested over the last 3 years. Okay, we're right on it. So if I buy gold at this level, my potential upside goes up at least to that upper channel line. That's a potential upside. If gold drops down and gets down here to like 155, it's broken a 3-year support level, and I'm getting out. Okay, because it's broken. So because if it breaks that support level, it's probably going down from there. So when I bought it, it was about 159.50, something like that. It's 159.54 as I'm looking at it on the chart. I bought it around 159.50. I put in a stop at 157.50. So I think my risk was like 1%. The other thing to take into consideration is that we have a price low here, a slightly lower price low here, but we have divergence in RSI, right? So that the momentum is shifting to the upside, right? And it's the same thing on the MACD. We have a low in the MACD here, and the MACD is much higher and turning back up. So I bought some based on that, right? My position size was a certain amount. If RSI gets above that 50 line and MACD comes up and turns positive, I'm going to add to my position, right? So say we're up here, say that happens and we're up here at 165. I've bought in my first position there. The indicators have shown that my initial idea of it was correct and everything's moving higher. I would buy more into it here and expect to come up to and test that top trend line. And I might sell some of it up here, right? If it breaks through this trend line, this support resistance level up here, it probably goes higher from there. So the point of all this is that the reason, I wouldn't buy it up here as an initial position, because your risk is that it comes all the way back down to support, right? And your return is only this much. But if you buy it down here at the bottom, you can identify a very small risk for a potentially really high return. All right, that's a really good example of risk management. And you can do it with the C fund too. I mean, if the C fund was a chart that looked like this, I mean, we have to take into account the 2 moves a month rule and all that, but this is a great place to get back into the C fund. You could do it by position sizing or whatever, but get back into the C fund, because if it breaks down there at 155, let's say, you get out and you take the small loss, but the potential upside was huge. So that's our perspective of managing risk, as opposed to the L funds and the other kind of passive ways to do it. Okay. TSP fund charts for the week. Like we said, we are recording this on, what's today? Thursday. So we did Wednesday's closing price. So who knows what's going to happen over the next couple of days. But on a weekly basis, even though it looks like, even if we finish where we are right now for the week, we're still below that 20-week moving average line. The trend, the channel clearly is still down. What we were talking about before, the bear market gets confirmed if we get below this low, right? The market comes down here, tests that 3,600 level, consolidates a little bit, and then drops down. The market's going lower. If we get down here to 3,800 and it turns back around and we get up here above this high, it keeps going higher, right? Because now it's outside of the channel.
High probability that will happen.
Yeah. There's not a high probability that it will happen, but if it gets above, I mean, so right now we're in the middle of no man's land. If it market goes higher and gets above this high, I'm definitely back in. I could get back in before that because it'd be above that moving average line. But if it closes below this low, I mean, that's it. We talked before about how these bear market rallies are a great chance to, if you've been in the stock funds all this time since the beginning of the year, and so then we had a 50%, you made 50% of your losses back from June to August. We talked about how to use that rally as a chance to decrease your exposure to the stock funds, because bear market rallies, when they end, they end like this. I mean, it's not confirmed until we get below this low, but my expectation is that. Okay. S fund, basically the same chart. We had 2 weeks, only one positive week, but basically 2 weeks above that 20-week moving average line since we got below it back here in November of 2021. There's nothing good on the S fund chart whatsoever. Even given this rally, we still only made it back up to that 50 RSI line. No reason to be in the S fund at this point. I fund is testing, right? It is testing the prior low, and it's probably the thing that's going to lead us down.
When you say lead us down, you mean that it's going to be a leading indicator.
Yeah, the I fund
Right.
at this point, I would say is a leading indicator.
If it drops below,
It's prior low in June.
right,
Yeah.
then that's a leading indicator to say the rest of the market may follow.
Yes.
Yeah.
It's very unlikely that the I fund goes to new lows.
My job is to always try to put that stuff in English.
Yeah, no, I appreciate that. I need that. You can't have the I fund going to new lows and the CNS funds going to new highs. It's not going to work that way.
Right.
I wish we had time to go into all the macro issues right now, but I'm sure everybody's aware that Europe is a complete disaster, and energy, the whole thing with Russia turning off oil completely came out this week that they're turning off oil completely, and OPEC is restricting its supply, and I don't know. My personal opinion is that's why Biden went over to Saudi there a few weeks ago. But we'll see how all that rolls out. I mean, there is nothing good on the macro landscape. Not a single thing.
By the time this show comes out, which you're not watching your phone because you're busy talking, but Queen Elizabeth just passed away. So, I mean, you can always pontificate about how life, current events affect financial industries, but that's going to be a big one. Because there's going to be lots of fear attached to, well, what's the next person going to do? How's this going to look out? Who's going to do what? And that's going to be a big. It's going to be a big thing in Europe. So.
They also just got a brand new prime minister yesterday.
Exactly. Yeah, I was thinking about that when I saw the news. I was like, oh wow, it's like a 1-2 punch. Yeah. Like you got a new PM, and the Queen passes. Yeah. Anyway.
And
not to sidetrack us.
The pound is almost at parity with the dollar.
Yeah.
Like in our last life, we used to travel a lot to Europe. I mean, those guys are living large now.
I know.
Because the dollar is going a long, long way. I mean, it's almost time to buy a flat in London. If you ever wanted to do it, now's the time to buy real estate in London or Paris or wherever. It's unbelievable.
If you're doing it with the dollar.
Yeah. Right. Okay. F fund, same thing. It's coming close to testing its prior lows. There's a lot going on in that bond space, and at some point the F fund is going to turn back around. When it does, we'll talk about it. But at some point, treasuries are going to, if the market does really completely collapse, treasuries are by far the safest place to be in the world, and so that. Not so much the AGG, unfortunately for us, because the aggregate bond index is some treasuries, but a lot of corporate bonds in there too. And the corporate bonds will definitely take the average down. But if you can buy 30-year treasury bonds, they're going to do really well at some point. Maybe we'll do a macro show someday. That would be good. That's how I would spend my time anyway. All right.
Questions.
Yeah, if you guys like the more intricate daily type analysis, that's what the subscribers to the site get. So
yeah, I was going to point that out because sometimes we have to do this show early before the market closes on Friday, and this is one of those times. And we're okay with that because our members, our subscribers, always get the full week analysis because Jerry waits until Saturday usually to really dig in deep, and then you get the full analysis by Sunday. Every Sunday at 6:30, all of our members get that analysis in a newsletter, and we're pretty proud of it.
Yep, it's a good product. You should check it out.
Yeah. All right, guys. If you have any questions, make sure you put them in the comment section wherever you find this video. If there's no comment section, you can always hit us up with an email at support@growmytsp.com, and customer support will get back to you, or they'll forward it to us and we'll get back to you. If it's something really personal, we might not be able to get into it with you because we don't do financial advice over email. But hope you guys have a great week coming up. And, a lot of memories for a lot of us about September 11th. We tried not to kind of
focus
get
on
into
that.
a lot of that. But that's impacted most of the people that we know, and of course impacted our lives greatly. So we always want to take a time out to remember that. But see you guys next week, and we're out of
That's
here.
it. We're out of here.
Bam! Got the show music back.